I'm gonna make sure.
Okay, I will now call the retirement board to order at 3:06 PM. With us is myself, John Burt. Michael Freeman is online. I see his name on there. Mark Ofinger, Carol Pratt, Jason Pollard, and Michael and John Burbank are excused for today. They were not able to make the meeting. Is there any board communications?
Sir.
Okay. Finance Director report.
How is everyone today?
Good.
Good. Can you hear me okay?
Yes.
Good, perfect. I apologize because I do have a little bit of a cold, so I'll try to speak a little louder this time. So we are talking about quarter ending September 30th, 2025. Expenditures for this quarter were approximately 3.2 million, with the majority of that being related.
We can't hear anymore. I don't know if it's me or.
No, it's not just you. I can't hear a thing.
I can hear you, Mike.
I can hear you. I can't hear them.
Exactly.
All those in favor of adjourning, say aye.
Oh, we had you for a second.
Can you hear?
Yes.
Hello?
Yes, you're back.
Okay, just again, I will send out an email to the group just as a summary if you missed any of what I just said. Just the last part of the revenue that I wanted to touch on was revenues in comparison to the same quarter this last year to this current quarter were significantly lower, but that was only because of the timing of when the town and Board of Ed portion of the actuarial valuation was transferred. It was done right at the beginning of October. So we will see that 5.9 million in revenue reflected in the next meeting. Are there any questions on that?
Thank you.
Thank you.
Moving on to the approval of the minutes. So moved.
I have one small correction on
Okay.
page 5. Last paragraph, it says what is, should be what is.
Okay. Any other changes? No. Carol, were you seconding too?
I will say.
Motion by Ofinger, second by Pratt, with correction. Any other comments? If not, all in favor, say aye. Aye.
Aye.
Motion carries. Moving on to authorization of payments from retirement fund, retirement benefits. We usually do this as one motion. Unfamiliar names in this batch.
I'm so moved that we approve the authorization of payments for
Second, Michael Freeman.
Motion by Pratt, second by Freeman to approve the authorization of payments. Any comments, corrections? If not, all in favor say aye.
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 Motion carries. SCI report.
Okay.
Hello, Pat. And then please
How
make
are
sure
you?
we Ron, or as you go.
Okay, can you see that okay?
Yes.
Yeah.
Okay, great. I'm gonna put it in slideshow mode. Okay, if the slides don't move forward, please tell me because sometimes it lags out a little bit. But I'll go through this. I'm going to save some material for Mark because I know he's going to go through the markets as well. So I'll just hit a few key points. And if you have any questions, feel free to stop me. So this is just your kind of executive summary here. We'll go through all these numbers. You can see the last change we made on the right side of the page here. Really, what we'll be talking about today mainly is several things. We still have that tariff uncertainty and the impacts to the economy. We have a lot of geopolitical tensions across the globe as we speak today. We also had a government shutdown, which just ended recently, so that was a big deal. And I'm going to talk a little bit today about valuations because I think that's pretty important as far as how we're investing our monies. So we'll talk about that as well. Okay, I'm on page 4 now. And this is just your general market indexes that we show you all the time. You can see that we had really strong performance on a year-to-date basis, calendar year-to-date, in world equity and emerging markets. They outpaced U.S. large caps. U.S. large caps and small caps still had really good returns. If you remember the first quarter, it was pretty rough for areas of the market like AI and tech. But ever since the first quarter ended, we've seen those stocks running again. So you'll see that theme as we go through the presentation. But all in all, it's been a solid year so far, year to date. All fixed income asset classes are up strongly. We saw high yield bonds, emerging market debt really add value to the portfolio. We actually increased the exposure to high yield bonds a little bit, and we added emerging market debts to the portfolio. That really benefited the portfolio, and we'll show you that when we go through the performance. So as far as U.S. equities are concerned, I mentioned first quarter we had we had a downturn in the market where a lot of tech stocks were in bear market territory, 20% sell-offs. That all kind of reversed course. So looking at the last quarter, you could see growth actually came back and beat value. When we looked at this in the first quarter, it was a complete opposite. Value was winning during that period of time. From a sector standpoint, those areas which you'd expect outperformed for the quarter, your technologies, communications, and consumer discretionaries. The more defensive areas underperformed those high growth tech stocks that really did well during the quarter. So just looking at it from a valuation standpoint, there's a lot of noise on this. You can read through it. I'm going to hit this really quickly. So essentially what we're looking at now, valuations for the S&P 500 are approaching the COVID era in 2020, and even moving towards what we saw in the tech bubble in 99 and 2000. So we have very high valuations, and it's very concentrated to just a handful of stocks. But it's making the S&P 500 price to earnings, the forward earnings it's going really, really high. So that is a concern, and that's why we made moves in the portfolio. We moved into U.S. equity factor base, which has those AI stocks, has those tech stocks, but a much lower percentage, and is really focused in on those more defensive value areas, which simply haven't performed in line with these other stocks. So we have that there for a cushion. Once those tech stocks sell off, I'd expect that to be one of your leading performing strategies in the portfolio, the U.S. equity factor base. So we're seeing really strong valuations in the U.S. When you look at it from an international standpoint, as I mentioned earlier, international really outperformed, and it was broad-based. Looking at it from the geography, the country, the region, we saw really strong performance in developed international and emerging, as I mentioned earlier, and you can see that across the board here. So why is that happening? Well, there's a couple reasons why that's taking place. One, We did see a pretty strong decline, almost 10% at one point in time in the US dollar. So we saw international perform better in regions because of the US dollar decline. In addition to that, the valuations are very, very attractive internationally. So that's the main reason we saw flows in those areas. So if you look at the developed international stocks, they're trading at a 33.7% discount to US relative to US stocks. So that's a pretty good discount. Emerging markets is even greater. We're closer to 40% discounts to US stocks in emerging markets. So we did have a good amount of international in our portfolio, and that did help propel your returns overall and just gave you a better experience this year. So diversification really worked this year, where it hasn't in quite some time, especially on the international front. Any questions around valuations, US, international, emerging markets? Okay, so we'll look at page 9 here. Not a lot has changed here since last meeting. We did have 2 rate cuts at 25 basis points. We have seen the yield curve steepen as overall. So we're seeing higher yields on the longer end of the yield curve than we do on the shorter end of the yield curve, which means, if we just go back a year, that was quite the opposite. You got higher yields in those 2-3-year treasuries than you did going out to 10 and 30 years. So now we have the yield curve steepening, so we have higher yields longer out in those longer maturity bonds and shorter on the short end. There's still an inversion, but the main thing many economists look at the 2 and 10-year inversion. That's gone. The inversion is really with those 1-month, 3-month treasuries out to the 2-year treasury. That there's still that small inversion there we're seeing in the yield curve. But with the Fed reducing rates on the short end, we should start to see that dissipate, depending on many other variables, obviously. And we talked about this already on page 10. There's 1 rate cut listed on here. There was an additional rate cut. We could see another, jobs data has come out. Unfortunately, we don't have all the data because the government was shut down. So we're not going to know the unemployment rate, but jobs have really started to falter here. And we're seeing that more and more. So the Fed is using that as ammunition to reduce rates. So it wouldn't surprise me if you had another rate cut before the end of the year this year, with that being said. Okay, so we'll get to the good stuff here. Looking at the portfolio performance starting on page 14. And this is just your fiscal year to date. So you can see here, you had a good return fiscal year, 4.87%. On a net, we underperformed just a little bit there. And we'll look at the year-to-date performance as well. I'd rather focus in on the calendar year so you can see the full picture. So we'll turn to page 16 where you can see the calendar year performance. And the plan was up almost 12% net of fees, net of all fees. And you can see here that if you look at the US equity row that goes across under the year-to-date column, US equities are up 13.03%. Look at the international. You have 17% of your portfolio allocated to international stocks. That was up 25.81%. So that's really, really driving your absolute return, the international space. From a fixed income perspective, we saw good returns on fixed income. 6.5 for core fixed, and limited duration was up 4.7%. And I talked about high yield bonds and emerging market debt earlier. They were the big winners on the fixed income side of the equation. So you had 7.2% on high yield bonds, and emerging market debt was up about 15.75. So really strong performance for those 2 asset classes. And your real estate has really bounced back from 2022. You can see year to date, that's up about 4.7%. So strong performance across the board for all asset classes. There's no negatives on your report. So it's been a really good start to the year. Keep in mind, we still have a month and a half left. So anything can happen. There's still a lot of volatility, with tariffs and everything else. Right now, the Supreme Court's reviewing the tariff policy. So things could change very quickly in this market environment. So we're keeping an eye on all that for you and making the appropriate adjustments to the active management strategies in the portfolio. Any questions about numbers, performance? I do have your portfolio value as of yesterday. It's down today in the markets. But as of yesterday, the portfolio value was 175,599,477. So 175.6 million as of yesterday. So we just got to get through this next month and a half and hopefully close out with a really solid year.
I have a quick question.
Sure.
Where in our portfolio might we see a hit if the Supreme Court forces the administration to give back tariff money to people that paid it?
I think you're going to see you'll see a positive, mainly for international and emerging markets. You could see potentially some of the U.S. side of the equation sell off, but all in all, tariff policies, the level that we're at today, is really unknown territory. It goes back to 1925, right? And we talked about this before. That the tariff policy that ended with a World War II. Hopefully, we don't see that take place, but I think you'll see international and emerging markets reap the benefits. You could even see the U.S. pick up as well because tariffs are already tax on individuals, right? So
Right.
if that tax goes away, it's going to start increasing consumer spending, and that could have positive impacts to the U.S. GDP. But there's a whole lot of other variables underneath the hood you have to look at. Once these tariffs go, if they do go away in some shape or form, that really drives a nail in the administration's coffin because their whole policy is built around tariffs. So if they keep this budget they have in place and the tariffs go away, the budget doesn't work. So it could create an economic mess for the U.S.
Yeah, I know you don't have a crystal ball, but I was just concerned something's got to give if the administration is forced to end its current policy and put it back in the hands of Congress. So I understand what you're saying about the international markets would reap a benefit. Individuals could, but the stock market's going to react to a lack of confidence in the administration's budget moving forward. And I was just curious if you had a guesstimate of which part of our portfolio would be the most impacted. But I understand that that's just a guess at this point.
Yeah, I mean, the one that's probably impacted the most will be your large cap index portfolio.
Okay,
You have some safety in U.S. equity factor base because that has a lot of companies in it, really strong financials. These companies that haven't really done much as far as performance. We saw them really do well in the first quarter, but since then it's kind of been stagnant. So those stocks, if we do have a major sell-off in the market, I do believe that those stocks that have been left behind for the last better part of a decade will be the best performers in your portfolio.
Makes sense to me. Thank you.
Okay. Any other questions? That's all I have. I don't know if they can hear us.
I hope so. I
I
enjoy.
think I just talked to you for the last 20 minutes.
I don't know. I will tell them everything's honky-dory and we'll move on.
All right.
But you did a great job.
Thank you. Did you take good notes? You can report back to everybody else?
They're recording the meeting, so they can watch
Okay.
it later.
Good.
Why is the market going crazy today? Do you know? I haven't read into it today.
Well, it's several factors. It's what's going on with the Supreme Court with the tariffs that we talked about. Lack of data coming out of the government now.
Yeah, that's a key.
That's a big concern.
Yeah, I would think the market's going to start reacting to not getting government information, but it's been relatively strong for the last couple of weeks. So,
Yeah, I mean, ever since the end of the first quarter, the market's just been running strong.
yeah,
A lot of that is really happening because of the rate cuts.
I didn't even look today until you said something.
Yeah, the rate cuts have been propelling the markets higher.
The stock market's so emotional, it's ridiculous.
Maybe I can send a message saying we can't hear them, or
I don't know.
message the option here. I'll raise my hand. Here's a chat. Here we go.
Testing, 1, 2, 3.
There you go. You're back.
Okay.
Did you hear any of my presentation, or?
Right up into, we heard Michael asked his question, your answer, and then it stopped. Carol has a question now. And let's, I'm afraid of this going on again. Let's kind of keep it moving fast.
Can you hear me? I don't think you can hear me.
Did you just hear it? Can you hear me?
Yeah.
Oh, okay, yeah.
Tell us, I want to know, did the SEI fees go up, and if so, why?
The only reason the SEI fees may have gone up is because we don't incorporate any of the index strategies under our OCIO umbrella. So anytime we add SEI funds, it goes back under the umbrella. So they may have gone up slightly from adding emerging market debt, US equity factor base. US equity factor base has a 0 fee to it. So it's just being applied to our OCIO fee. So that's probably what you're seeing. The good news is
Pat,
all those
this is
changes
Mark.
actually benefited the plan significantly.
Pat, this is Mark. Can you hear me?
Yes.
Okay, so you made reference in some of your comments about certain information either not being available because of the government shutdown. I guess my question is a little broader than that. My general sense is that a lot of the typical economic data that we've all relied on, to me, is somewhat suspect for a variety of reasons. And I don't want to make this a political discussion, but are there alternative sources of data that you have or would consider using if things don't kind of, even if the shutdown ends and things get back to normal, the normal, isn't normal.
Yeah.
So I'm just wondering, are there other sources of information, documentation about how the economy is doing that you guys, and this probably also applies to Mark, have access to or would utilize if the ship doesn't get righted at some point in terms of either hiring people back, not having the president and others dismissing economic data, survey information, and so forth and so on?
Yeah, that's a great question, and I don't have an answer for all that right now. I think this is an evolving thing that we're speaking, as we're going through right now. There's several surveys out there that don't come through that exact channel that we could leverage still. But this is a bigger problem, your question, for all economists, for all financial industries, because this needs to get figured out. Because if it's not, we're just like China. We'll just be another China if this doesn't fix itself.
I think from like a jobs perspective, you get the ADP reports because they control payrolls, so they can give us an insight on job creation or losing jobs, things like that, to help validate the government's job report. They're usually in tandem. They're not exact, but they're usually in tandem. I think they look at slightly different time periods, but there's some reporting from some of the larger credit card companies on consumer debt. JP Morgan, the Citibanks of the world released some of their data. So even when the government was shut down, you listen to the Fed governors, and they weren't flying totally blind, but they didn't have the full amount of information that they would normally get from inflationary standpoint jobs. But there are third-party private companies that do release data that can be relied on.
Well, maybe I'll just throw it out there, and John, it's up to you. Maybe this topic could be something that we could put on the next agenda. I'm still of the belief there's a total disconnect between what's really going on in the country and the stock market. It almost gets back to Mike Freeman's question of, well, if the tariffs are pulled back and in my mind, I still think there's a disconnect. I think we're living in la la land in terms of how the stock market's doing. And at some point, somebody's going to wake up. And so not to debate it now, I would love to have it give you guys a chance to kind of look at it a little bit and maybe tee it up for a short discussion.
Yeah, we can add that to the next one. Sure.
Yeah. Kyle, why don't you and I maybe touch base before the next meeting?
Yeah, let's do that, because there's so many different reports. I mean, we can give you the important ones. I'm thinking like Beige Book, things like that. But some of that is still impacted by the government shutdown. And, we lost our key data person as well. Or didn't officially happen yet, but that's still there too. So there's a lot of moving pieces here.
Okay.
So
I think we discussed too last time, but just the diversification of the portfolio. So if the US has a shock, markets drop, you're seeing a sell-off today. I think we're roughly only about a third of the portfolio is in US stocks. And oftentimes if the US stocks dropping, either bonds will rally or international markets. So we're not too concentrated in any one market or asset class. That's
the importance of diversification. So
thank you both.
Awesome. Okay, we'll touch base there, and we'll have something, maybe an agenda item for next meeting.
Okay, excellent. Thanks, Pat.
thank you.
All right, I just have a few comments. We have an organizational update at SageView. So I know about 5 years ago we were infused by private equity. We were about half of our shares, our ownership of the company was purchased by private equity with the intent that we would acquire another company or be acquired at some point. We have a tentative agreement with a company called Groton. They are out of Kansas City, very large financial services organization. It's individually owned. It's got a couple private backers. It's owned by a gentleman named Peter Maluk, who owns part of the Kansas City Chiefs and part of the Kansas City Royals as well. Primarily, they have been more of a wealth shop. So while SageView works with clients like you all on large corporate retirement plans or government retirement plans, they do have a portion of their assets in those types of plans. They basically acquired us for our infrastructure in the 401k, 403b government retirement plans.
Let me just interrupt.
Yeah.
Hey, Pat, can you quit sharing your screen?
Oh, that's mine.
Oh, it's you. Oh, sorry. I was not even paying attention.
Yeah,
I didn't see
no,
the
it's
president,
okay.
but sorry. Sorry about that.
So I think long story short, we anticipated it coming. It was a good outcome for us. Our president is going to stay on retirement plan division. We have about 3 times as many of us as they do in retirement plans. So they're kind of joining our group. Our wealth management was very small, so they're excited to join kind of a bigger group with creative planning. We don't offer financial planning for you all, so it really is kind of non-impact. There's no change to our Boston office. We have a few folks from Connecticut in Hartford that work for creative planning.
Is your name gonna change?
Probably, that's in, we're gonna keep it for a year and then we may keep it and just, it'll be Sage You Advisory Group, a creative planning company. That's what they've done with a couple other acquisitions. That's personally, I've worked with Sage You for, it's my 18th year, so I'm kind of hoping to keep it. I was the 28th employee. We grew to about 300 and now I'm part of 2,300. So a little bit of change there, but honestly, we don't expect much.
But creative planning is buying. you guys.
They're buying us, yeah.
Trust.
So it was, we looked at some other larger acquisitions for us to buy. We had some smaller acquisitions over the last couple of years. Looked like, kind of saw the writing on the wall mid-year this year that one of our larger, almost competitors would buy us. Any questions there? Happy to share the press release. John, I think you might have touched base with Mark Foster. Something like that.
Yeah, if there is a press release.
Yeah.
I'd be interested in.
Yeah, I'll send that as a follow-up. The deal is expected to close in December of this year. See, we'll see if that goes through. I'll give you an update on our next.
Thank you.
I don't know if I have too much to add. I have our presentations, the format and the sequencing is kind of similar. It's usually very comparative with SEI. I think a lot of our charts kind of talk about it. I think a couple of things, continued strong performance, of course. Cooling labor market is a big one, and it's got the Fed kind of on the fence on what to do with inflation and a slowing job market. Consumer spending has remained strong, but it's become a K-shaped economy where you've got the people that are making the most money are able to keep spending and in fact increase it. So the top 10% of wage earners are kind of keeping us afloat, while the folks at the bottom end having more trouble keeping up with inflation. So they're actually spending less. The overall number has remained strong, but I think that's something to watch as we head into when we last met, we had a lot of neutrals, if you remember, a lot of uncertainty over tariffs, which we still have, but a little bit more clarity. So now we're kind of divided into some strong positives, but some concerning negatives. Pat hit on those leads from a positive standpoint. Companies are still making money, so earnings are good. That's generally what drives stock market prices higher. Interest rates, the Fed is helping us out with 2 cuts, maybe one more in December, potentially a couple more next year. We are doing our part for the most part of spending money, and overall growth numbers did increase, revised upwards. Again, government data, but revised data, second quarter growth. Things we're watching and worried about is the continued underperformance in manufacturing, the high debt, the debt levels. Helps in the short term when the government spends money, but in the long term it can be a drag. Global trade obviously is front and center. Job market stable, but kind of stagnant. So we're kind of watching that. People aren't leaving their jobs, but companies aren't really creating new jobs. And we're starting to see the AI effect where companies, and I have a college graduate where some of the AI is replacing some of those entry-level jobs of kids getting out of school. So it can be replaced cheaper with technology. So something to watch there. And then inflation is running a little hotter than the Federal Reserve. I think Pat covered equity returns and fixed income returns. I'll jump in. So really what we do, again, at Sage, our job is to take a second look at the underlying investments that are in the plan and we compare them to their competition and their benchmark. We apply a 9 criteria overlay. Say how is the performance versus their peers and their benchmark? How much risk did they take to get that performance? How consistent were they? How did they do in good markets like we've seen recently? But more importantly, how did they do in down markets? So we apply these 9 screens to all the funds in the plan, and then we assign a score. Best score you can get is a 1. That means you beat everybody in your peer group. 100 would be the worst. And our goal is really to be top of technical now and have SEI be top of their second. On average, they score in the 20th percentile. So on average, they're beating 80% of their respective peers. And then this slide just walks through each of the actively managed funds and how they did versus their competition. And in the far right column, I'm on 24 of our presentation, gives the overall ranking. Again, lower is better as you look at this chart. Fund like the SCI limited duration bond, it scores in the 34th percentile. That means it's beaten 2/3 of its peer group. And you can see it gets pretty solid scores across the board. A couple that are top decile, a couple that are maybe a little bit more middle of the road. And then if you kind of run that right-hand column down, three of the 6 actively managed funds are top decile. They're beating more than 90% of their competition. And the other 3 are around top third, top quartile. So very strong numbers. If you remember the emerging market debt fund for a little bit was on our watch list. It was scored in the 3rd quartile. It's a little bit of a tricky asset class, not a lot of funds in that class, and SEI a little bit different in their approach, but that fund came off our watch list a couple quarters ago. It's not now top of the top. Then SEI incorporates 4 index funds. Fund SCI, the large cap index, and then small cap international emerging markets. So those all score well. Really just watching the cost on those, how well they track. But we have nothing on our watch list, so kind of an all clear as of 9:30. Any questions from the stage use perspective? And even when we're creative planning, I'll still say sage. I bet I'll be.
Okay.
Yes, we're keeping our employees. I think the only overlap, and the reason why companies merge is for economies of scale. Some of our folks in compliance most likely will be let go because they already have compliance. Their CFO will take over for our CFO. But all of the practitioners are here to stay. That's really what they're buying is clients and the talent. Our president, who's been at the firm for over 40 years, he's going to run the retirement division.
But your CFO goes.
Our CFO does, yeah, which is, she was actually relatively new. She came on from the private equity firm. She fully expected. It's funny, the people there, part of their job was, to find a place for us, kind of knowing that their jobs would cease.
Okay, thank you. Next up, we have the regular meetings, 2026 regular meeting schedule. These dates work for people? And if so, I entertain a motion.
So moved.
Second.
Motion by Heffinger, second by Pratt to accept the 2026 regular meeting schedule. Any comments? If not, all in favor, say aye.
Aye.
Aye. Motion carries. Is there any other business? I don't think there's anything here. Okay, if not, our next meeting is going to be on Thursday, February 12th. And I would entertain a motion to adjourn.
So moved.
Second.
Hey, all in favor, say aye.
Aye.
Aye. Hey, motion carries. So we are adjourned at 3:45. Thank you, everyone.
Thanks, everyone. Have a great holiday.
Yeah.
You too.
You
Happy
too.
Thanksgiving.
Thanks. I can't believe we're here already.
I know, it's so weird. Yeah.